Today I'm going to talk about what is a stock. So a stock is a type of investment that represents ownership in a company. So when you buy a stock, you own a small piece of that company, and that is called a share. So a couple of things just at a high level. The typical returns you're going to see are 7 to 10%. That is adjusted for inflation. Inflation is usually about 3% a year. Exchanges, here's two of the big ones: New York Stock Exchange, NYSE, and the NASDAQ. Couple things to keep in mind. Dividends are something that sometimes stocks pay out. So they're going to pay out a portion of their profits. Typically they're paid quarterly, sometimes they're annually, sometimes they're monthly. I'm going to give you an example here to see that below. So let's say you own Coca-Cola. You had 100 shares of Coca-Cola. They're going to pay 50 cents per share per quarter. So that means every quarter on top of your earnings, you're going to make $50 just for the dividends, which is a great plus. Some of the top dividend paying companies: Johnson & Johnson, Coca-Cola, PepsiCo, 3M, Procter & Gamble. There's a huge list. If you went into ChatGPT or Google, there's tons of companies that pay dividends. Obviously, they're not required to pay them, but if you look at 20 to 50 year companies that have been paying them a long period of time, those are generally your best bets. A couple other examples here. So let's say you owned Apple. You invested $1,000 over 5 years. Your return is 118% in that period. This is real data I'm using. So your net would be $2,180. Of that, you'd have $1,180 of capital gains. You do need to pay taxes on this if you pull it out. If you just take those gains and you reinvest them like we did in this opportunity, those gains can just keep making money on top of money. Compound effect is something to keep in mind. That's just basically, as you invest money, that money is going to earn money, and then that money that earned money is going to earn money after it. A couple other tips to keep in mind. Beginners usually start with index funds versus buying individual shares. So individual share would be like Apple, Johnson & Johnson, Coca-Cola, Pepsi, 3M. Index funds, just think about, instead of buying one share of each of these, you're buying one share of a group of these. So an index fund could be VTSAX. That's a common one. There's 3,600 companies. Every time you buy one share, you're buying a piece of 3,600 companies. A couple other things here: Simple Path to Wealth by J.L. Collins. That's an amazing book if you're getting into investing. And The Psychology of Money by Morgan Housel. That's another book I highly recommend. If you found this video useful, please like and subscribe. Thank you.